One of the most common questions we get from business owners is it better to lease or buy a company car? Hey taxpayers, it's Tiffany Gonzalez CPA here, and in this video, I'll walk you through how to decide what's best for your business based on your budget, mileage, and tax strategy, as well as long-term goals. Let's start with a general rule of thumb. Leasing is often a good option if you plan to use the car for 3 years or less, if you expect to drive it within a limited mileage range, and you don't want to make a large financial commitment up front. On the other hand, if you plan to keep the vehicle for 5 or more years, you expect high usage, and you want more flexibility, buying may be the better long-term investment. Now, I'm a CPA, so we have to consider the tax advantages and the cash flow options of each scenario. Let's start with leasing. One of the biggest benefits is that lease payments are typically 100% tax deductible when the vehicle is used 100% for business purposes. This includes not only the monthly lease payment, but also the related costs like insurance and maintenance. Additionally, leasing requires little to no money down, so it's ideal for preserving cash flow, especially for small businesses. And since monthly payments are lower than financing, you may be able to afford a newer model with the latest safety and tech features. On the flip side, leases do come with mileage restrictions, usually around 12,000 to 15,000 miles per year, and additional fees if you go over. That means if you or your employees are frequently on the road for client visits, commuting, business travel, leasing might not be the most cost-effective long-term. Leased vehicles also can't be customized, so if you're planning to add a company logo, a wrap, or equipment on the vehicle, buying is likely the better fit. Now let's look at buying. Although upfront cost is higher, purchasing a vehicle gives you access to tax benefits through depreciation. Under IRS Section 179, you can deduct a large portion or even the full purchase price of qualifying vehicles in the year they're placed in service. Bonus depreciation may apply as well, depending on the vehicle type. And if you're purchasing an electric or hybrid vehicle, you may be eligible for additional federal or state tax credits. Plus, once the car is paid off, your monthly costs drop significantly, and you can sell or trade it in later to recapture some of the investment you've made. Ownership also comes with a fewer restrictions. You can drive as much as you need, you can customize the vehicle to suit your brand, and you can use it however your business demands, whether it's deliveries, rideshare, or carrying heavy equipment. Just keep in mind that long-term maintenance costs are your responsibility once the warranty ends. So, which is the better choice? Well, if your business prioritizes cash flow and tax deductions through operating expenses, lower monthly payments, leasing may be the way to go. But if you want ownership, long-term savings through depreciation, and the flexibility to use and modify the vehicle freely, buying is likely the smarter option. Ultimately, like many things in life, there's no one-size-fits-all answer. Think about how the car will serve you, serve your business, do the math, look at your long-term goals. And of course, if you're our client, don't forget to tell us. We'll make sure we account for it in your books and that you're maximizing any potential tax benefits, which obviously there are tax benefits for both leasing and buying. If you found this video helpful, don't forget to hit the like button, subscribe to our YouTube channel, follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next time, your favorite CPA, Tiffany Gonzalez.